Welcome to Insights. I'm Eric. I'd like to have another economic review in reference to a article published by the Chicago Tribune over the weekend, which suggested that she said if the $2 trillion stimulus package, or nearly $2 trillion stimulus package, was passed, the economy could recover to full employment within a year. So let's take a look at that statement, and in doing so, we try and check the sarcasm and laughter at the door and take a serious look at that. Proves to be a lot more difficult than it looks, but I'm going to do it anyways. If we look at the labor part, and I've shown these charts before, getting back to full employment, there's the real world employment, and then there's the employment that they generate. That's the statistical employment, and it might be easier than you think. The fact is civilian unemployment rate is 3.6% reported through the household survey. I mean, that pales in comparison to the 25% that was recorded during the depths of the Depression. But the fact is, the statisticians are not using constant calculations the whole time. Today's 6.3% is nowhere near what 6.3% was 100 years ago. There's a lot of statistical tricks that they use in order to lower this number. So Yellen's statement that full employment, and I don't even know what full employment is, 5%, 2%, they could get there. I mean, you don't have to use real world employment numbers. You can massage it downward until you get to a number that you want to see. And how do they do that? Well, they fool with the civilian labor force. I mean, here's one example of that. There's different measurements. They call them, I don't even look at this stuff too much anymore, but it's the U subtitles or headings of employment, U6, U12, and things like that. But the civilian labor force is shrinking. Now, I seriously doubt that people are actually retiring here. They're just pulling out of the civilian labor force, and the government assumes that they're never coming back. So after the original COVID hit, the civilian labor force crashed, and we've bounced up a little bit. I mean, this is where I have to say, be careful of assuming that this recovery is going back full bore and we've got a V-shaped recovery. Well, the labor force situation does not reflect a V-shaped recovery. We have a bounce, but it's not even halfway to where it fell, the midway point of where it started to fall. So Yellen's suggesting that we're going to get back to full employment. Does that mean full employment without the labor force restoring to itself within the trend, or is the labor force entering another downtrend and it's going to continue to either chop sideways here or head back lower? We don't know that. Another chart that I showed the other day in the last review is the summation of the employment payroll numbers, and this is just the difference between the current month and the previous month, and then you sum them together to get an annual labor creation or an annual number of total jobs created. And we can see that during corrections and expansions are up here, corrections or contractions are down below the zero line. The zero line is the hash line. That in general, most of the contractions were contained within this trading range until about 2009. Then things started to get ugly, and then this next wave of it, clearly it's far more ugly than even in 2009. So the Great Recession, to end all recessions, has been topped by another even greater recession, of which nobody's even acknowledging that. And it doesn't really matter. I mean, you don't acknowledge it, it doesn't exist. So, but the suggestion that we're going to get back up here and float around above the hash in an expansion area, it's a far-fetched story. I mean, you might as well tell about the fish that got away, the big one, rather and equate that with returning the economy to full employment. I don't know how they're going to do it. I mean, it's unlikely is the best way that I can describe it. And the fact that they're going to do this by issuing more debt is amazing. Debt got us into this problem, yet we're going to provide $2 trillion worth of stimulus through more debt issuance. I'm going to show you a chart or set of charts that I've shown before. This is the total credit market debt relative to GDP. So it's top line is all the debt in existence relative to the national income, domestic income. And we can see that the debt levels in the Great Recession climbed above the Great Depression. So Clearly, the Great Recession of 2008 was much bigger than they even let on. And as the COVID striked and hit, we spiked above that to make even higher highs. And now we've fallen down a little bit, but we are quite a bit higher than we were in the Depression that caused all sorts of trouble. And if you take a look at it on how much that debt is buying us in terms of economic growth, this is another look at it. We can see that in the Great Depression, we had to issue debt, but a lot of the debt started to collapse in itself. But the debt that we carried generated 32 cents of, for every dollar of debt we issued, we got 32 cents of economic growth. That expanded into the 50s to not even quite 1 for 1. We got almost 70 or 80 cents. But since the 50s, we've been falling steadily. And even after the Great Recession, now we fell below the Depression lows of 32 cents. And now for every dollar we put in, we get 26 cents of economic growth. And within the COVID situation, and I don't even know what they're going to classify this, the Great Recession, Depression, we're heading down quite fast. These numbers are lagging. They don't show up, but I suspect in the next couple quarters, we're going to see numbers down here. So the problem is we're going to have more debt, we're going to have less economic growth, and yet we're going to have a stimulus package that issues more debt to get us out of the deep hole that we're in. So to suggest that that's unlikely is not too far-fetched, but again, that's probably not something you're going to see hitting the the news wires too soon, or they're not going to talk about that one on the nightly news. This last chart in which I'm going to end this discussion is really the computer. Now, I know everyone's going to believe what they want to believe, and ultimately, I use the computer and the matrix in itself. This stuff's all inside the matrix in order to define what the world is actually doing. I mean, you can't live in the realm of BS forever because the invisible hand doesn't buy the BS. It sees what it's actually going on and it positions its money relative to that. Now, the belief is that the economy has recovered, and this measure right here is the long-term economic growth. This is the marginal activity. So an economy is either accelerating or decelerating. It's not a linear type of situation. It's a second derivative of that. It's acceleration. And the acceleration is either up or down. If it's up, it's in expansion. If it's down, it's in contraction. And we've made this slight little sliver that suggests after the lows that we're starting to turn higher. Now, could we turn back down again and fall back into a contraction and deceleration? It's possible. One of the measures that I look at is the intermediate. That's the faster moving. There's the long term and then the intermediate cycle or oscillators. The intermediate oscillator is already turning over. If this falls below zero, it's going to pull this over. So there are risks associated with the assumption that the bull expansion is quite durable. It usually doesn't make slivers, but it can make them. And if we look at longer term and we zoom in a little closer, we see a sliver, a bull sliver here, but there's been bull slivers before here, of which then it's fallen before. We've had them here. We've had smaller slivers or a little bigger slivers, but they've also turned over. We've had them most notably in the 70s and 80s. Now this one only goes back to 1945, so this excludes some really important time periods. But slivers to the upside do exist. It's not safe to assume that an intermediate trend, which is already starting to roll over, which would likely pull over the long-term trend, that it can't happen. Now we can watch this in the coming months and see if it holds. This is inside the matrix, and I would subscribers keep a close eye on it. It's something that we'll talk about specifically, but I'm not going to talk about here in an open discussion. So the real question is whether or not the economy can return to full employment by the end of next year. The suggestion that it's probably wishful thinking, yeah, that's basically a good assessment of the situation. Now, wishful thinking is a lot of times all we get from our current state of government and leadership, and perhaps that's all we can handle. I have no idea. There is reality, and there's what people want to believe, and I rarely see the reality being positioned. People, remember, are too uneducated. I mean, they're flat out. They just think they're too stupid to understand all this stuff, and I think that's wrong. I think people are smart. They have a gut feel that something's not right, and they get tired of having things explained in the most simple terms, but then they find out that it was all a lie. I'm not saying that this is a flat out lie. This is something that we're going to have to see how it evolves, but there's certainly risks here to the wishful thinking that everything's going to return to normal, and I think that's what I wanted to convey. So I want to thank you guys for watching, or everyone for watching this video, and if you have any comments or questions, contact me through the blog that's below the video down in the link section, or write some comments in the video as well, and subscribe to the channel, and consider subscribing to the Matrix so you can see this stuff evolve firsthand. So thanks for watching and have a great day.